Jenna, I'm going to start with yourself. A nice simple one, given where yields are in bonds, is have we seen the best of returns from bonds? Is this as good as it gets?
I hope so. The pace of returns in government bonds in the last 12 months has been extraordinary. It's I think it's the 7th largest government bond rally in 30 years. So you've got kind of 15% returns from 10-year treasuries, a little bit less than 10-year gilts from the peak in yields. So to do that again from here would imply economic catastrophe, given the starting point. But that being said, I'm not too bearish in terms of how high bond yields may retrace. I think there's a good chance we could push a little bit lower in yield, given the global outlook. So yes, the best of the returns is hard to replicate, but the outlook is still very fragile, and there's a big debate about whether this is a soft or hard landing, which we'll obviously work through in the next 6 months.
And Claudia, from your perspective, I guess that's a lot about developed markets. Is it the same picture in EMD, or are we at a very different point in the cycle for you?
I mean, we had also a fantastic year in terms of returns this year that was driven by a couple of elements. One was, yes, the base yields on treasuries, or to a lesser extent, bonds and so forth, the core yields basically, but also the spreads in emerging market valuations were quite cheap at the end of last year. So we had a good starting point in terms of valuations, which is why we returned in dollar terms about 14-15% year to date. Looking to next year, I would expect a bit more moderate returns. Basically, don't expect spreads to tighten as much as what they did this year. And at the same time, I think I concur, we're not going to see this additional rally on core markets. Having said that, because emerging markets, it is an asset class that produces higher income in general, as long as things stay steady from a spread perspective and rates in developed markets don't back up massively. And I think for that to happen, we need to see a massive increase in global growth very quickly, basically that the central banks are behind the curve, which I don't see that happening next year. So if you just assume things, still rates maybe not falling further on developed markets, but not rising either, carry of about 4, 5, 6%. Now funds, I can probably talk about 5.5 to 6. It's not necessarily horrendous returns, especially because the base is so low. Negative yields in the Eurozone are very low yields in this country.
Okay, Adrian, perhaps you won't focus on your previous bond experience, as we were just talking about, perhaps more of a hobbyist than a specialist. So we'll perhaps start with equities for you. And given we're perhaps now in a lower growth environment, is it still possible to deliver income growth from equities?
Yeah, clearly it's going to be much more difficult. If the economy isn't really growing very much and inflation's at 1.5%, the chance that your company that you invest in wins a new contract, can put up pricing, it's going to be tougher to drive forward the dividend. But it is there, and it's really, really important you get hold of it, because that is the thing that's going to drive the value of your portfolio. So the portfolio I run, it's an equity, UK equity portfolio, yields 5, but the most important thing about it is the dividend growth is 5%. That's the driver that's going to drive your capital value through. But there are plenty of shares in the London market that don't grow their dividend at all. It's static, and you must take that into your thinking. That's very much like a bond, with risk, obviously. So really, you've got to search out that dividend growth. But it is there on quite ordinary companies. National Express grows its dividend at 10%. You know what it does. Wincanton, I saw them yesterday. They're growing their dividend at 7%. You know, these companies have yields greater than 4. You know, they're good to have in your portfolio. It's possible. But don't get deluded that you're going to have a portfolio that's growing its dividend at 10%. That's going to be taking on some incredible amount of risk in it, probably not what you'd like from your equity income fund.
To bring that to life, in one of your big positions is BT, for example, which I guess has been a stock that's been shunned and unloved for a long period of time.
Yeah, it's a new holding for us in the fund. We didn't start with it a couple of years ago, but we've come to it with the change of the CEO, the clarity on the pension, and a few other bits with Ofcom. The point is, it doesn't grow. This company does not grow. The top line is static. And so for 99% of investors, it's of no interest whatsoever. It has a good dividend, but that's all its cash. There is a debate now whether it should take a bit of that off the table, shove it into open reach at the right terms, and start to make some progress. We've joined the shareholder list at this point because we think that's absolutely the right thing to do. We think there is a a mood for connectivity from all political parties to get this done. It is a badge of honour to have good high-speed internet. And so I think that you are going to see better terms from Ofcom. BT will change the shape of its dividend, think 30, 40% less. You're still going to get a yield of 5%, but you're going to get growth in the business. And that will bring a whole new raft of investors who've been standing away from BT going, boring, not growing, no thanks, extra Diageo for me. They will look at it and go, oh, it is growing. Not dynamic growth, but let's say single digit. And it will be a single digit grower with a 5% dividend yield being run by a new management team with some enthusiasm. That's why we've turned up, and I'll be back next year to tell you why we sold it. No, because it's going to happen. I said it here.
And Jenna, from a credit perspective, when you think about some of those challenge businesses that maybe aren't growing or can't grow, does that worry you from a fixed interest perspective?
Not in my portfolio. We're very focused on kind of high quality BB, high yields and investment grade where there aren't many problems. But there are definite signs of distress emerging in the credit markets, concentrated at the very bottom end of high yields, so CCC, and particularly in the loan market, where that's basically where this vintage of bad credit deals has been done in this business cycle. And you're starting to see rising downgrades, rising distress, and a few defaults coming through. So that's all really a function of this low growth environment where companies aren't growing into their capital structure, they're not deleveraging, and investors are getting impatient and not wanting to refinance those companies. So that trend, I would say, is actually accelerating and accelerated in October, even as equity markets were rallying on hope that the global economy was going to rebound. When you look into the outer reaches of the credit market and the lower parts of the credit market, it's getting quite concerning. But so far it hasn't filtered up.
And Claudia, from your perspective, your fund's yielding nearly 6%. This is a session about investing for income. That's a pretty attractive yield. Do you think investors misprice risk in EMD, or do things like Argentina and its problems, does that remind us that actually this type of area should be paying a high yield?
No, absolutely. I mean, there's always something that potentially could move very quickly. We had Argentina this year, Lebanon, and several countries. So I think one of the lessons in emerging markets is hopefully you avoid as many of those as possible. But if you ended up making the one bad investment decision and being invested, you have to size your positions adequately. In other words, you're not going to put a huge position of a portfolio in something that if it goes wrong, it goes badly wrong, because that's what will give tremendous volatility to your portfolios. I think the good news is if you look at the asset class, when I started a long time ago, I'm getting old, we had about less than 20 countries to invest, and they were mostly sovereigns in hard currency. Now we have more than 80. The corporate space has grown tremendously as well, and increasingly we are getting more and more local markets, so local currency bonds that are available for investment as well. So this means from a diversification perspective, we can choose various things in the portfolio. There may be countries that are, for example, commodity importers versus exporters, that are higher quality credits, worse quality credits, different sectors within companies. So eventually, even though everything has a commonality of being emerging markets, there is still sub-flavors within it, so that hopefully if you had a bad call wrong, then there's several other things that hopefully could also be offsetting. And
back to the equity environment, you used to run one of the biggest equity income funds in the sector, and I guess things like capacity and liquidity have become quite topical over the summer for a variety of reasons. Now, what's your view on how you run a smaller fund today? What's your view on how you should manage capacity from an equity perspective and thinking about offering daily liquidity to your investors?
Yeah, so firstly, running a small fund is actually much more fun. I'd just like to say that and get that straight out there, because you can actually do what you discover. You can get on with purchasing or you can get on with selling, and it's not something you need to concern yourselves with. I think the whole debate with capacity and liquidity, we need to be very careful as an industry. There's something gone very wrong in one specific area, and a light's been shone on that. And even in, I have to see our risk committee on a regular basis to go through the portfolio, but they have absolute numbers they've just made up out of thin air. It's got to be 95% liquid. And these numbers are not relevant, because the relevance is the relationship I have with my clients. My clients have asked me to produce a portfolio to outperform the all-share, produce a better yield than the all-share, and have that dividend growing. That's what they want. And with that, they want active share of sort of 80%. Now, this is going to require some risk-taking. This is going to require some exploring parts of the market that may not be that liquid. I'm not talking about unlisted. That's a completely different science. This is full list shares, and that's exactly what we're doing. But we're doing it with the blessing of our clients to go and explore these areas because they've asked us to do it. And I think it's very important that people understand the relationship between fund manager and client and don't try and blanket bomb us all with everything's got to be 95% liquid. It doesn't matter if you're doing bonds, property, small cap, large cap, whatever. Otherwise, you will end up with a myriad of index funds.
Is liquidity issue still the same in fixed interest world?
Definitely been a reach for yield into illiquids within the credit market. And we saw that a year or so ago. And generally, we felt that these illiquids have been over-marketed as some sort of kind of alpha harvesting, and people don't understand them, and they're cheap because they're illiquid and not everyone looks at them. But actually, they're cheap because they're illiquid, and oftentimes because they're riskier than standard corporate bonds. So we've seen that drift going on for 3 or 4 years. And corporate bonds are relatively illiquid to start with, so to push out the liquidity curve was quite punchy. And private debt is a good example, CLOs another example, which are all sensible at certain points in the economic cycle. There's a time to buy them, but they're not cheap every year. And actually we felt that those got very expensive. They were over-marketed. And actually, to be fair, most of those were held in closed-end vehicles, not so much in open-ended. But it has been fashionable and we're a bit wary of them.
Yeah.
And corporate bonds, as I said, by their nature, they're illiquid. Well, not completely illiquid, but not as liquid as equities, and that's what you get the extra yield for. It's not really to compensate you for default risk, particularly on investment-grade bonds. There was a great Bank of England study that showed most of the extra yield was actually for the relative illiquidity and ratings downgrade risk. So corporate bonds is enough for us,
Yep.
and I think the industry has probably pushed a little bit too far into illiquids and over-marketed it.
I'd be interested, Claudia, to get a perspective from an EMD as well. I mean, you talked about Africa, which people would assume to be naturally quite illiquid, and your fund's grown well on the back of some very good performance over the last few years. So you have to think about that liquidity and how much of an issue you're happy to take.
No, absolutely. So we have also internal guidelines and limits in terms of country exposure, in terms of the size of the bonds that we would invest in. For the countries that might be a little bit less liquid than the rest, of course, we have to have a much longer time frame in terms of our investment horizon. So we would expect to be holding those positions for several years, which means in terms of we need to have then a multi-year view in the country in terms of the economy, the politics, and so forth. But there are opportunities to be had. But as I mentioned earlier as well, sizing the positions it remains very important. So you need to make sure also you're sizing them appropriately, but and understanding also who potentially the investor base for some of those bonds. I remember when I was my prior job in 2008, there was tremendous amount of outflows from the asset class. But surprisingly, there was a couple pockets of the market that were extremely liquid because in some cases there was bonds issued by the Philippines that the Filipino banks didn't have any issues in 2008. All the problems were in the Western banks, so they were happy to buy those bonds. They had the liquidity, so occasionally understanding who is the potential final buyer as well is also important.
It's most definitely up to keep us on track. So thank you very much to Adrian, to Jenna and to Claudia. I hope that was useful. And please join me in thanking our panel.